Hey, good morning, everyone. Marty Missouri here. It's Friday, the 10th of November, 2023, with your end-of-week market snapshot. I'll try to keep it relatively quick. I did dial up several screens for you. Later today or over the weekend, I'll do our full-on weekly economic update. So this morning, for the first half or so of the presentation, just my monologue, but I am going to run through some charts, not the technical analysis, but just some data that I want to share with you. The first one on your screen is the University of Michigan's Consumer Sentiment Survey results. They came out this morning for October, and as you can see, they broke back down further below our little trend line here at 60.40. The consumer respondents to the survey just simply are not feeling good about either their present situation nor their forward outlook. Interestingly, while they don't feel good about the economy, they anticipate that inflation is actually going to heat back up. So you kind of get the worst of both worlds. On one end, you get something that actually the market seems to be rallying on and hoping for, and that is weaker sentiment, a weaker economy, a softer Fed. But that suggests that weaker inflation that allows the Fed to be softer. But just in terms of consumers and what they're feeling right now, inflation expectations, though, are actually going in the wrong direction. So yesterday we listened to Chairman Powell come in notably more hawkish than he was just recently at the Fed meeting, and he even said that we may not be tight enough. We may have to tighten some more. The market liked that yesterday like a bad toothache, which just compounded an earlier negative, and that was a pretty awful 30-year Treasury bond auction. Just didn't get the support or the buying interest that you would hope for it with rates as high as they've gotten. So that is a narrative that a lot of people are throwing out there, that there's going to be so much Treasury issuance because of these big deficits going forward, and the world's just not going to want to buy them like they normally do, and that's going to push yields even higher. I'm not all that sympathetic to that view, quite frankly, as many really smart people are. I think ultimately economic conditions are going to win out, and we are going to see yields come down notably lower over the next few months than they are right now, with a lot of choppiness in the meantime. But we'll keep an open mind and continue to report to you regularly on how that is evolving. So I want to kind of continue to make that same point, that only for the moment, bad or weak news is good market news. So on your screen here, you've got that University of Michigan survey score going back 30 some years. And notice here, as it begins to roll over before the 1990 recession, notice that stocks actually were kind of trending, in an opposite direction. So the economy, the data or sentiment was beginning to weaken, and stocks weren't really that disappointed. You can see that here going into the tech bubble, right? You can see that here definitely going into the great financial crisis, right? And you can see it as sentiment was flattening out going into the COVID blip of a recession there. So my point, again, as illustrated in this chart, is that often the Fed has been tightening policy, markets beginning to waver, then it begins to work, the economy begins to slow, the market just says, okay, well then the Fed's going to back off. But then when you get into recessions, this is the point I keep making over and over again, and why you need to exhibit some caution here, is because if a recession is coming, not good news for the stock market. Let me illustrate that as I did in Monday morning's note. Again, the view is that, hey, when the Fed eases off, stock market party on, right? Well, here we have the Fed raising interest rates going into the tech bubble bursting, right? And here's the Fed easing off, right? Here's the Fed pausing and obviously getting somewhat softer in their language, and boom, there's the stock market, going up with it. Notice that when they actually started cutting, was the beginning of the end, and that was a 50% decline, 80% if that were a NASDAQ chart, right? Here we are going into the great financial crisis. Fed getting soft, pausing, no more rate hikes. Boom, market screams higher for a little while. And then the reality of recession and Fed cutting, stocks go down almost 60%, right? So here you are right here, late summer, early fall 2019. Our index rolled over. We put on an options collar. We were having a really good year, 2019. I think our core was up like 18% year to date. And while we didn't react to this, there was still an optimistic macro picture in our view, and we're glad we didn't react to that. Here we were getting defensive, but I warned you over and over and over again that we're probably going to look stupid for a little while because the Fed is seeing what we're seeing. The market was even still rallying when the Fed was cutting. Obviously, it didn't believe recession was coming. COVID being the so-called catalyst, we thought a recession was coming anyway, essentially gave the political cover for doing just an utterly enormous amount of money printing. And therefore, they never let the things that would normally play out during a recession play out. That could be problematic. We've been warning that for quite some time here. So what do you mean? My whole point, again, is that, sure, a softer Fed can be good, but if we have a recession, that softening is just going to be trying to, catch a falling knife. And we do expect that, as typical, that stocks will bottom, somewhere during the recession. Tech bubble was a little different, right? But typically, our indicators will tell us that it's time to go long in a bigger way before the recession actually is officially over. Now, these things are measured typically in retrospect, meaning we didn't necessarily know we were starting a recession right here. We learned that when the National Bureau of Economic Research officially put these dates together. Anyway, that's that point I keep making. Now, one more illustration for you is the chart of the S&P where I put on scores here at various points of our PWA index. We actually invented the index back in July of 2017, and these are all just back test scores. And I was showing this a lot back here when we started hedging, and I was showing right when it was time to get cautious here before the Great Recession. Stocks screamed higher for a little while, certainly did that back here before the tech bubble burst, but our score was actually in the red. Our score said recession odds are high. They're, below zero means recession odds are favored over continued expansion odds. Here in the 1998 Russia default, long-term capital management going belly up, 20% decline for stocks was not something actionable for a long-term investor who invests along with macro conditions. And again, here's where we were when we had that 20% correction in 2018, but here's where we had to start getting defensive. And clients, as you know, we mitigated the lion's share of that. And here we are present day with some, with not a good overall setup, something that says that recession odds are pretty high next year, and we better respect that right now. So folks, obviously by our actions, we're not worried about catching, the last 10% of a bull market. Or necessarily the first 10%, although if we do get this shakeout that we think is likely to come, we will be buyers before everybody else is. I think that's typically our MO because stocks get just too cheap to ignore. It doesn't mean all at once we'll be scaling into things. So folks, there's just more to play out. Clients, I would say we need to continue to be very, very patient right here, not get caught up in the day-to-day fluctuations. Looking at our core portfolio, yesterday we held up well. We're still down a little bit, but gold did well. We had a lot of commodity-oriented things, which interestingly did well yesterday. Today, stocks are up, commodities are down a bunch. A global macro portfolio. It's going to do different things at different times. And right now, quite a bit of exposure to short-term treasuries inside of a money market account. Nice that the yields are north of 5%, of course, but we're really not trying to game everything the stock market has to offer. So anyway, I could keep rambling about that, but nevertheless, folks, just my point here is that This is not the stage of the cycle where you expect a new raging bull market to happen. Anything's possible, but conditions would have to change notably for us to take that posture. Happy to take that posture. We will be taking that posture again. It's just right now, clearly, this is not the time to get super bullish for stocks if you're anything but perhaps an investor with a 2-month time horizon. Another couple points with the short term in mind. You remember going into last week, we were pretty bullish. The technicals said look for a rally. Sentiment was in the gutter. The red line here is AAII, that's individual investor bearish sentiment. The green line is bullish sentiment. So folks, here's where we were going into last week, right? Just huge bearishness. We were seeing it in the advisor surveys. And so I said, that with the technicals, with the bearish technicals on yields and on the dollar, man, this looks like a pretty good setup. Sure enough, it was the best week of the year. Well, going into next week, we'll see. I do think this thing could have some momentum to year end. That kind of seems to be the view. But when I say that, that means we're getting bullish. We've actually crossed over right away. Everybody kind of is rushing to this rally in terms of sentiment. Also seeing it in the advisor survey. VIX is at low levels, very complacent levels right here in our view compared to what reality probably is, or the fundamental reality, if you will. This is not that crazy bullish setup that we had, say, going into last week. Doesn't mean it won't play out to be a pretty good week. I think it can, but I can't come to you with any short-term great conviction. And then just one more before we get to the technicals. I mentioned in my midweek update, I didn't show it to you, but I said that the NASDAQ advanced decline line still looks, I can't remember the term, abysmal essentially. And that's still the case. So the breadth. So this is the NASDAQ composite index price. And this is its cumulative advanced decline line. Goes down or up based on advancers versus decliners each day, right? And notice that it was rolling over before the 2020 brief bear market, right? And notice it was turning up before the bottom. Rolled over before this correction, rolled over here, rolling over big time before the all-time peak and the bear market that we think we're still in. Right? Here we have now a nice big trend. This is the kind of bearish signal you need to pay attention to. Essentially not a healthy market by definition. The 2014-2016 market, I keep thinking about that one because it was 2 years of a lot of volatility, but point to point, the market didn't do anything. So here we are in November 2023, right? And here we were in July 2021. So 2 years of essentially nothing from a price standpoint. You could draw a straight line. A lot of volatility along the way. Similar chart in the 2014-2016 range. I didn't pull that up. I probably should have. But our breadth indicators actually started breaking out to the upside 6 months before. So when I was doing videos back then and we were managing client money, of course, we got bullish after a really nauseating, tough period to be in the market. This kind of feels like that, except the problem, of course, is that the breadth indicators are suggesting a break to the downside. And that's consistent with the fact that we think one of these red shaded areas is coming, right? Back then, definitely not the case. Back then, we didn't see recession coming, and we thought that was actionable. Okay, so folks, I hope that was helpful for those of you who just like to listen to the monologue. I'm going to jump into the technicals. I will tell you, though, that as I get into the technicals, I often get into things that I wish you would have heard. So I'll try to keep it quick if you want to hang in there. If not, please have a great day. And I'll have the economic update for you here in the next day or so. Okay, so that's the 2-year chart of the S&P 500. Let's just narrow it in a little bit. Here's your 1-year look. And so, folks, we, again, this was that easy call to make. And, man, what a rally. It's gone further, I got to be honest, than I thought it would, right? Here we are bumping up exactly at the high, right where the market fell apart on October 17th. That's exactly where it stopped. Found support at the 50-day moving average. The fact that it's sloping down is not bullish, I must say. Have some gaps in here. Talked about that when we were looking at small cap stocks. It'll probably get filled before this is all said and done. In terms of momentum, this isn't bearish. You actually have a higher high on the MACD and a higher high on the RSI. So we don't have bearish divergences here. We just have running into some overhead resistance, and this looks like a really key area right there, about 4,400, we'll call it. So we'll see how that plays out. If the MACD continues to roll over here, it can get bearish in a hurry, but easily this thing could pop. You've got this overhead downtrend line. If you break through that, as the NASDAQ has, that would be bullish for the moment as well. So not having strong feelings in one direction or the other, certainly not from anything I see on the daily chart. In terms of the NASDAQ daily chart, here's that same downtrend line, and here we broke through it. Remember, we did this last time. I said, you break through that with some momentum, come back and retest it, and then you pass that test. That would be very bullish for the end of the year rally in the Qs. Break down below that with some momentum, and you have a failed breakout. Of course, that story is yet to be told, but it'll be told in the next few days. In terms of momentum on the NASDAQ 100, same kind of luck, right? This is not one of those bearish divergences I always talk about. It is a market stopping right where it stopped in October. So we'll see. It's going to be interesting to see how that plays out. In terms of yields, remember also part of our bullish case for last week was that we were bearish on the 10-year yield. It looked like a classic, at least from a technical perspective, that it would break down. It's coming down today as well. Big rise yesterday, which really did a number on stocks. So yields right now are negatively correlated to stocks. We think they'll be positively correlated if we have a recession, and that means both will be going down at the same time. In terms of the dollar, we came into the month bearish. The dollar, well, that was really bullish for stocks, but then we see the dollar kind of climbing back into this range right here. Still looks bearish from a momentum standpoint. The dollar is pretty flat as I speak at you here today. So we'll see. Right now, the way things are trading, a weak dollar is bullish for stocks, but currencies and commodities and stocks trade on different things at different times. So, folks, I will leave it there. Message today on a short-term basis is somewhat ambiguous. I am sympathetic to the notion that we could get a pretty good year-end rally before all's said and done. But going into next year, things look pretty precarious to us. And certainly, if the things we're concerned about continue to develop in the direction they have of late, the market very well may not make it till the end of the year in rally mode. All remains to be seen. So for now, we'll continue to keep an open mind and stay on our toes, and hope you all have a wonderful weekend. Take care. Bye-bye.